What's up, traders? I'm the Inner Circle Hotshot. I am not an educator. My educator is ICT. For free education, check out his YouTube channel, The Inner Circle Trader. With that being said, this channel and video is for entertainment and my own learning purposes only. This is not financial or trading advice. I am not a financial or trading advisor, so please trade at your own risk. This video, before I even start, I do want to say thank y'all for hitting our 50 subscribers. That's pretty dope. That's really awesome. Um, and then y'all be loading up the views on these videos, dude. It's pretty awesome too. So I appreciate y'all throwing likes on the videos, y'all viewing the videos, subscribing. If you're not subscribed, hopefully we can earn your subscription in the future or at the end of this video. But today I do want to go over how you can approach the market using ICT's 2022 model, but for Forex. If you want to see like index like NAS 100, SPX, or US 30, I can totally do that on a future video. Right now, I'm actually focused on Forex simply because this Monday, I'm actually gonna begin taking the evaluation for FTMO. I'm gonna be doing a 50K challenge, um, and I'm gonna be implementing certain risk management plan that ICT actually provided. Um, really beautiful. It allows 14 losing trades in a row before you actually, get to minus 9% on the account. Obviously, I don't plan for that to happen, but this whole risk management model really actually prevents you from, losing a challenge. Honestly, you really just got to hit some nice risk to reward ratios, bring yourself back, and you could really do it up. Anyways, I don't want to go into that. This Monday I do want to do a challenge and I am focused on Forex right now, but like I said, I can make an US 30 SPX NAS 100 video because I do study them and I do plan on trading them whenever I am full-time trading. As of right now, I'm not. I plan on it real soon whenever I get funding and then I scale up my funding. So we'll go ahead and, you know, I do want to just give an example of how you can approach using the model though. If you notice, like if you've seen my last videos, daily bias is how we approach it. To read it, you want to go from the last run of liquidity. You can see that was right here. Then price, this was the market structure shift point. And you can see that price barely wicked it. That counts market structure shift. And you can see that there was gap right here. Now the candle that shift structure, the fourth candle, you got to allow it to open, do its thing. But this candle, once it closes, if it's up here, then you would go back through the leg. But this candle can also be the one to tap you into that fair value gap. So that's my rule. That's what I've learned from my own back testing. And you can see that price, as soon as price came back into it, this is the reversal, retracement. So this is your expansion, reversal, retracement, expansion. In other words, price is spooling, taking out this liquidity right here. Once it took that out, retracement, minor retracement into what? This down close candle right here, which would deem as an order block. Boom, retraced, expansion, took out this liquidity here, this liquidity here to the left, and this liquidity right here as well. I apologize about my hound. I have a hound in the background. It's my dog. Um, anyways, you can see that it expanded. In other words, price from here was spooling and then it began consolidating. So once it consolidates, it's possible that it can break up again and then retrace, or it can even come back even lower. We'll just have to see what happens. Anyways, how you can approach using the 2022 model. Let's say from here, after the retracement, the daily price begins spooling. Now, honestly, you really do want to get in whenever price is spooling. In an expansion phase, that's really whenever you want to go in and hunt these setups because they actually give like the best opportunities. Because if you see, obviously, you know, reading the candles. Once it's spooling in one direction and the bias is bullish, you want to see open, that manipulation, aka the Judas swing, to then rally up. And obviously you want to get in on the wicks. And you can see whenever price is spooling, like ICT says, you'll rarely see closes opposite of the spooling. So you'll have more winning days than losing days as long as you stick to that. I wouldn't recommend like going in and trading like retracements just because it's like considered counter trending, like a counter trend trade. But again, it's totally up to you. I don't like to build bad habits. It's totally up to you, your preference. Anyways, so let's just say, for example, after these 2 days, price is spooling, right? And it's heading towards this liquidity. Right now, bullish. We want to see price from this point open, Judas swing, manipulate down. Obviously, we know it's going to happen from hindsight, but Judas manipulate down and then distribute, take out this liquidity, and ultimately take out this candle's high as well. We want this candle's low to support. One thing that people say, and one thing that ICT pointed out too, that I really like is a lot of people are like, because there was a comment on my short too, like it's easy to read price whenever it's in hindsight, and ICT says it all the time. That's actually how you learn. I mean, that's how doctors learn, from people who've done it already. That's how dentists learn, from people who've done it already. It was hindsight. They needed examples, proof, like shown. Like it's really bizarre, his, the way that he puts sentences together. Anyways, so in this case, we're going to go ahead and drop down because this day right here is Wednesday. So we're going to be looking for Thursday. Okay. We're going to be looking to trade Thursday. So we drop down to the 15-minute. And then we're going to go to Thursday's 2 o'clock because that's whenever London kill zone opens, 2 to 5. And then we're also going to mark out our midnight because we want to know that time. And then we're also going to mark out our 7 to 10. That's the New York kill zone. Okay, so we have all that marked out. Let's just play price up to those points. And then we'll stop price whenever it gets close to there. Okay, boom. So now this right here is our midnight open price. So we're going to label that all the way out to 10. And we're going to label it as midnight open. And so now at this point on the 15-minute, we could even drop to the 5-minute, see it a little clearer. You can see that there's all these relative equal lows right here. What's sitting below that? Liquidity. And we're bullish. We want to be below the midnight open. We want to be entering below that because the midnight opens and then it creates the wick on that daily candle. And we want to enter on the wick. The wick can run out this liquidity, run it out, and at that point we could get in on the bottom of the wick and then catch the day's move up to this high up here to take out the previous day's high. So if we just kind of play it out a little bit and see what happens, let's double check and see if there's also this fair value gap right here too, to point out that price can respect. It can come down in here, respect it, and then take off. So this is the first point of interest and second point of interest, okay? So what are we looking for? We're looking for the 1 minute. As soon as price taps into here, we're looking for the 1 minute to market structure shift bullish, but we'll see what happens, okay? So we're right here. So right now, the market structure shift point would be right here at this high. Oops, not that one. Why this high? And go watch ICT's 2022 mentorship and you'll understand market structure shifts. I think like episode 6, he explains them in detail and you'll understand it there. But this high came in at 0. If you look at these numbers right here, this high came in at 0.92963 and this high came in at 0.92963. So they're equal highs. Okay. So if in that case, if price takes out this high, that would be a market structure shift. with a huge displacement candle. Now this one has to close. Oh my goodness, look at that. Now, once this candle closes, this is where you mark out your fair value gap. Okay. Now let's just go back through and just kind of see what's going on. Price right now is actually doing like a market structure shift. But I apologize, y'all. This is 1 in the morning, and we wouldn't be looking to trade at this time. We're only looking to trade from 2 to 5. So anything that happens here doesn't really matter. So honestly, I'm just gonna play it out. We would have lost anyway, and that's why we don't trade during this time. We gotta wait till the kill zone. I just snapped. I do apologize. I make mistakes. Every trader does. But we're gonna wait for price to get over here, and then we'll look for the 1 minute opportunity. So let's just jump back to the 5 minute. I'm gonna delete these because these don't really matter at all. Okay, we're still below the midnight open. So right now we're creating that daily wick. And you can see that we just took out that liquidity. Let's wait till 2. Bummer, it already took off. That is a bummer that it took off before 2. Okay, so at this point, it is unfortunate, but you can see that once it took it out, took off, and this happened before our kill zone, and we only enter in the kill zone. You don't want to enter over here. Don't break rules. Don't create bad habits. I mean, but every trader is different. If you want to trade over there, do your thing. I wish you the best of luck, but ICT says don't do it. Now, I'm going to show you how you still could have taken advantage of this move. You can see that once 2 o'clock did open, check this out. On this candle, on the 2 o'clock candle that opened, minimize that, boom. Once 2 opened, if you see that it's already expanding, the shift happened. Well, the shift happened on the 1 minute, but you can already see that everything's already happened. Right here, you can see that this made a fair value gap right here. With the 2 o'clock candle, well, this is 2:30. Oh, so 2 o'clock is right here actually. And it still did it right here too. But look at, if price is expanding, you can see that there was this gap right here off of these candles. Once 2 o'clock open, this is 2:05. Boom, tapped into that fair value gap and then took off. You could have been a buyer right there. You could have dropped to the 1 minute. Honestly, I'd probably just take it off the 5 minute to see that it swept out this liquidity here. Oh no, look at, swept out this liquidity right here on the 1 minute. Boom. And then this is a market structure shift point up here. Price market structure shifted on this candle. Remember the rules that I told you. You got to wait for the 4th candle to open, close. Sometimes it'll be the one to tap into a fair value gap, but oftentimes it'll create a fair value gap. And then boom, look at, douche, douche, boom. And now you get in on a lower time frame entry from here. And then you can put your stops below this candle for like 3 pips. But my rules for myself is to put it below this candle. I consider this the 1 candle of the 1, 2, 3 fair value gap pattern. I consider it the 1 candle, and I always put it below to the next pip. So that's like with a little bit of breathing room. So I put it at 5 pips even. And then where are we targeting with this? We're going to target that previous day's high, which is this big black line right here. And it'd be about a 2.84 risk to reward. But again, here's another example right here. As soon as this fair value gap was created, boom, boom. Next candle taps into it. Could drop to the 1 minute and see what happens. Oops, I did not mean to press that. Let's just exit out of that. So it taps into it here. Here's the market structure shift point because And this high, price took out this high right here, this liquidity, and then came down, took out this liquidity. So it took out both sides, and then it creates this high right here, like relative equal lows, the market structure shift with the displacement candle. So now the next candle has to open, close. Okay, so no fair value gap, no market structure shift here. Now it's possible that I can come back down. Okay, so this is now a new point, and our market structure shift point is going to be right here now. See what happens. So this is actually the new market structure shift point right here. And it shifted. Why is it the new market structure shift? Because it retraced back, created a failed lower low. So it created like a higher low, took it out, and then it retraced back down. It's taking off a bit. So right here, there's like no fair value gap or anything either. So I wouldn't even look to enter. Okay, so I just created another low right here. Boom, created a low. And then the market structure shift point is here. Now, I know this might be confusing y'all, but I'm telling you, like you really just have to like study and understand. Shifted, this next candle has to close, create a gap, and then we'll look for entry. Okay, see it went down, there's no gap. Created another low. This is the market structure shift point now, right here. So price takes it out. Boom. Now there's a gap right here. So this next candle can either go up one and create another gap, or it can come down, tap us in, and we will enter on that candle. Okay, so that's fine. Either way, this is the gap that we're focused on now. So price comes back into this. We're looking to buy. Boom. And stop loss will be right down here. Both tips. And we're targeting that high again. 5-8R. Let's see what happens. Price took off from us, and that's totally fine. It happens. Totally happens. Unless it just tagged us in. Imagine. It totally respected everything. Look at it, tagged us in, never hit that previous day's high. Instead, it engineered more liquidity, as ICT would say, because it left some relative equal highs right next to the previous day's high. That's just creating more obvious logic that price is going to take that out. And right here, you can see that below this candle, I've said it previously, as long as this candle gets respected, that fair value gap is respected. So you can see that price actually held the fair value gap. So if you would have left your entry, left your stop loss, and left your take profit, you would have still hit take profit on that and take profit on this one too. Boom, boom. And that's how you could have taken advantage of the London session. Let's see if there was any opportunity during New York. Obviously, it already took out the previous day's high. So maybe like New York can give like an optimal trade entry, like a retracement opportunity to get in like maybe the middle of the wick. Now, obviously, like with these trades, they're a little riskier. You do want to, if you are a buyer, you want to trade, you want to be buying below or at least a little relevant to it. With this one, it probably wasn't that bad because ICT says from here, you can see ICT says from this range down from the midnight opens range down, duplicated. So if you clone it and you duplicate it up, yeah, there we go. Then you can enter within that range. This is the whole range that you can enter in. So this is a good entry. This one's probably not the best entry. This is a super risky entry. But you would, if that's a pyramided entry, then you would want to cut your risk anyway. So I mean, it's totally up to you. But this is a good entry right here. It hit about a 2.84, nearly a 1 to 3. If you would have held beyond it, obviously it hit a 1 to 3. Anyways, let's go to the New York. Let's see what happens. So yeah, so New York, you can see that it's retracing, giving like possibly an optimal trade entry. We want to see whenever 8:30 opens, we want to mark out that open price. But right now there's like liquidity right here. That price can turtle soup take out, and then we can look for like a 1 minute entry opportunity. I apologize about this, dog. I really do. But you can see right here that there is this fair value gap on the 15-minute that's being respected. Because again, if I just delete these over here, because they don't really matter now. Delete this, delete this, delete this, delete this. Okay, so if we look at this fair value gap, let's just delete these. If we look at this gap right here, you can see that the one candle is being respected. So I would say that that's like a valid fair value gap that's being held. Let's say on the 1 hour too, you can see that it's even bigger right here. I'd probably just leave it as a 1 hour fair value gap personally. Um, and then the candle to be respected is down here. So a lot of room. It can go all the way back down to the midnight open, which would be cool. But let's see if we can turtle soup real quick. No, it didn't turtle soup. You know what it did was it held that 15-minute fair value gap, which was this one right here, aka or the 1 hour fair value gap. But it held it right here. This one candle of the 1, 2, 3 fair value gap pattern was not violated. So let's just see how you could have entered right here. For example, if we would have brought it back to 7 o'clock open, let's say that we're right here and we recognize that you could drop to the 1 minute and you could be anticipating that market structure shift. You could say that it happened right here, but at this point it took out the low. So now you're looking for a new market structure shift opportunity, and you can see it right here. As soon as 7 opened, took out all this, boom, and then the market structure shift point was right here. Took it out. And there was no fair value gap, so I wouldn't have entered, but it did come into this down close candle, which is like technically an order block. But you can see I wouldn't have entered, and price ended up coming back down, taking out more liquidity from here. And then the market structure shift point was right here for me. And now you can see that there's a fair value gap. After the shifting candle, we wait for that fourth candle to close. Closed, boom, boom. There's a gap from it, boom. And as long as this one candle right here is respected, that's a valid fair value gap for me. Okay, so I would take the entry right here, boom, as soon as price tapped into it. And this was at 7:41 in the morning, New York time. And of course, I'd be under here at the next nearest pip. So that would be 3 pips because I'd give it some breathing room. And I would target, where are we at in price? Let's just go back to the 5-minute really quick. So we're above the previous day's high, and we have all these other highs over here. We probably come back up here. You know, honestly, I'd hold for a 1 to 3R. That's what my strategy actually targets. I target a 1 to 3R just because the long term it actually benefits better than anything less. And ICT's concepts like this actually hit 1 to 3Rs pretty often. So according to my back test anyway, you can definitely go in and check for yourself. But let's play this out, see if we got stopped out, or yes, we got stopped out. And that is totally okay. So losses happen, you know what I mean? So let's say that we took an L right there for the morning shift, right? Well, we took an L right here. Price took out more liquidity right here and right here, took out liquidity. After that, where's the market structure shift point? Boom, right here. This is your market structure shift point. This is your market structure shift candle. Wait for this candle to close, and you can see there's a little gap right there. Boom, boom. As long as this one candle is respected, that's a valid fair value gap for me. And I would take entry off of this candle, which came in at 801. I put stops at the next nearest pip, so it'd be 2 pip stop loss. I'm targeting a 1 to 3R. See what happens. And we got stopped out again, and that's totally okay. That is fine. So with the risk management plan that I have put in place, let's say that this was a 2% loss. So this was -2. The next trade, we're going to cut our risk. So this would be -1. And this following trade, we're going to cut our risk again. So the next trade, we're going to place a 0.5% risk. Okay. So right now, the next trade, we would place a 0.5% risk. But let's see, where's the market structure shift point from here? You see that price took out the wicks right here, shifted price right here, but there was no fair value gaps, came back down, shifted price again right here, shifted bullish right here, boom, next candle has to open, boom, there's your gap, you're gonna boom, boom, and I'm gonna look to take a buy off of that gap. Stops below the one candle to the next nearest pip. So 6 pip stop loss, and I'm targeting a 1 to 3R. See if this one hits. We didn't get tagged into this one. Instead, what it did was it tapped us into this one. Which actually is a valid entry point as well. I just missed it in this case, so I wouldn't count it. But in my strategy and for my own notes going back, hot shot, make sure that you notate this for your own self, that you were supposed to take entry off this. As long as once this candle closes, one, two, this one shifts, this one creates the fair value gap, you let the fourth one. I'm gonna have to back test that a little bit more, but you can see that it tapped into this one. If you would have been a buyer right here, for example, put your stop loss below the one candle, which was here, 7 pips, 1 to 3R. See if it hits it. It's still up here. Came all the way back down. Oh well, maybe it's a good thing that we didn't. So New York session was a bummer. We made a little bit of bread in London, but yeah, New York session we lost that bread. Cause in New York, no, in London, we hit about a 1 to 3R. Let's just say it was a 1 to 3R, and we were risking 2% initial risk. That was a 6% gain that we hit there. So 6% minus 2% equals 4%, minus 1% equals 3%. So altogether, it'd be about a 3% day. So it'd still be a positive day, plus 3%. And if let's say that we enter this one, did it ever stop us out? Look, it never stopped us out. Look, it never stopped us out and it hit a 1 to 3R. Let's just say you entered on this one right here, right? It never stopped us out because it never came down and took out our stop losses or anything. Let's say you held it throughout the whole session and allowed it to play out during New York session. Well, during the kill zone, and then let it play out during the session. That's actually my strategy. If I set it, I place a stop loss and I place that 1 to 3R take profit and I let the trade play. I do not manually close it. I don't mess with it. If I place it, it's gonna hit either the stop loss or the take profit, one of the two. I don't even do break evens. I don't do that either. So let's just say, like for example, again, I'm not gonna trade. I'm not gonna count it. It was a 3% day all in all. But let's say that you did hit that 3R right there. This was a 0.5% risk with my risk management plan that ICT taught me. So 0.5 times a 3R, that'd be a 1.5% gain. So we'd make this back and we'd still be down minus 1.5 for the day. So it'd be 6% minus 1.5. So altogether, we'd make 4.5% on the day if we entered in right here and we held that. But that's literally how you can trade ICT's kill zones, implementing that daily bias checklist. If you don't know how to implement that, check out the recent videos. And if you're not already subscribed to the channel, if you stood to the end, I appreciate that. Make sure you drop a like on the video, comment if you do want to see the indices approach on NAS 100, US 30, or S&P 500. And if you're not subscribed, hopefully I earned your subscription, or, hopefully we can definitely get that going in the future. But until next time, thank you for watching.